I made every rookie investing mistake in the book. Lost money, panicked, YOLO'd into hype stocks, and watched my portfolio burn in real time. Not fun, but hey, at least now I got a great story and a tax write-off. When I first got into investing, I genuinely thought I was good to go. I downloaded a trading app, watched a few YouTube videos, maybe skimmed half a book, and thought I was good. Then I saw my first red chart and immediately considered switching to crypto mining. It was bad. But here's what I learned. Knowing what not to do is just as important as knowing what to do. And today, lucky you, I'm sharing all the mistakes I made so you don't have to. These are the top 5 investing mistakes beginners make. And if you can avoid them, you'll be way ahead of most investors and miles ahead of my younger self, who thought AMC was a retirement plan. So let's dive right into mistake number 1, which is trying to time the market. Ah yes, the famous buy low, sell high strategy. Sounds simple enough until you actually try it. You think you found the perfect time to jump in. Boom, the inflation report drops. You wait for the market to cool off. Boom, stocks rally 15%. You finally buy. Boom, everyone starts whispering about a recession. It's like trying to jump onto a moving treadmill in flip-flops. Look, trying to time the market is basically a guessing game, and even professionals with decades of experience and Bloomberg terminals still get it wrong. That's why I prefer dollar cost averaging. You just invest a set amount on a consistent schedule, every week or every month, no matter what the market's doing. It removes the emotional roller coaster from investing, and the math actually works in your favor. When prices go down, you buy more shares. When prices go up, you buy fewer. It's simple, it's boring, and it works. There are tons of studies that show it's one of the most effective long-term strategies, especially if you don't want to stare at charts all day or make investing your full-time job. And let's be real, you're not going to perfectly time the market, but you'll absolutely outperform the guy who's been waiting for the dip since 2016. Moving on to mistake number 2, it's not diversifying. This one's for all the I put everything into Tesla people. Look, I admire the confidence, truly, but putting your entire portfolio into one company is like walking into a casino, throwing your life savings on red, and then lighting the roulette wheel on fire. It might work out, you might double your money, but you might also end up watching your retirement fund ride a roller coaster while you Google how to short the stock I'm already down 60% on. That's where diversification comes in. Think of it as your financial seatbelt. It won't stop crashes from happening, but it'll keep you from flying through the windshield when they do. And no, buying 5 different EV stocks doesn't count. That's not diversification. That's themed gambling with better branding. Real diversification means spreading your money across different industries, asset classes, and even countries. That could mean a mix of stocks, bonds, ETFs, REITs, basically more than one idea at a time. Because if one sector tanks, tech, real estate, crypto, whatever, you don't want your entire net worth going down with it. If everything you own is perfectly correlated, you're not investing. You're just concentrated stress with a brokerage account. So, if you're not sure where to start, go with broad market index funds like VTI or an S&P 500 ETF. It's boring, don't get me wrong, but it's proven. And best of all, you don't need a Reddit thread to explain why it's tanking. So now let's talk about something that most investors overlook, and that is ignoring fees. Let's talk about this silent killer. You see a 1.5% expense ratio and think, it's just a percent. But over 30 years, that tiny little number can cost you tens of thousands of dollars. And that's not an exaggeration. That's your compound interest quietly getting siphoned into a fund manager's ski house in Aspen. Here's how it works. Say you invest $10,000 with a 1.5% fee. You're paying $150 every year, whether that fund goes up, down, or sideways. And that doesn't sound terrible until you realize that $150 reinvested over 30 years could have grown into a car or a house, or at least, a vacation that didn't require sleeping in the airport. High fee funds are like gas station sushi. Yeah, maybe you'll be fine, but is it really worth the risk when there are better, safer options that won't leave your stomach or your portfolio wrecked? Stick to low-cost index funds from places like Vanguard, Fidelity, or Schwab. They charge you pennies on the dollar. We're talking 0.03 to 0.1%, basically the cost of Lint. And they still outperform most high-fee actively managed funds. So here's a rule of thumb. If the expense ratio is higher than your GPA in high school, walk away. Unless you went to Harvard, in which case, congrats. But still, walk away. Moving on to mistake number 4, Investing without a clear goal. When I first started, I was just throwing money into the market with no real plan. Was I saving for retirement, a house, a yacht, a lifetime supply of burritos? Honestly, I had no idea. I just knew investing was a good idea, and I figured I'd sort the rest out later. Investing without a goal is like going to the gym and doing random exercises while blindfolded. Sure, you're moving around, you might even burn some calories, but you're also pulling a hamstring and wondering why you're not seeing any results. The point is, direction matters. Without a target, it's impossible to know what strategy actually makes sense for you. So figure out what you're investing for. If you're looking to retire in 30 years, you'll want long-term growth. Think stocks and index funds. If you're buying a house in 3 years, you might want to stay more conservative. Think bonds. And if you want a spontaneous Vegas trip, maybe just keep that in a high-yield savings account, or maybe don't invest it at all. So set your goals first, and then build your investments around them, not the other way around. Because if you're just throwing money at random assets and hoping for the best, you're not investing. You're just playing financial darts in the dark. For the last mistake, we're going to talk about reacting emotionally. If you've ever checked your portfolio and immediately felt like throwing your phone across the room, congrats! You're emotionally invested in your investments. And that's not great, especially if you got an iPhone. That thing costs like $1,200 now. Panic selling during a dip or FOMO buying during a hype wave are two of the fastest ways to sabotage your portfolio. We've all seen the meme, I'm a long-term investor until my stock drops 3%. And if we're being honest, we've all lived it. The reality is, the market goes up and down. That's just what it does. There's no smooth, straight line to wealth. It's more like a chaotic staircase with missing steps and surprise trap doors. That red day you're staring at? It's just noise. That green day you're celebrating like you hit the lottery? Still noise. The goal isn't to win on Tuesday. It's to build wealth for future you. And that version of you is hopefully relaxing on the beach, not still refreshing Robinhood every 30 seconds like it's Instagram. So breathe, stick to a plan, and remember, emotion is great for relationships, but terrible for investing. The truth is, investing is a long game. You're going to make dumb decisions, maybe panic a little, and yes, probably lose money. I know that I have. But if you learn from those moments, adjust your approach, and keep showing up, you'll be just fine. If you got any value from this video, or at least got a laugh at any of the terrible jokes that I made, go ahead and hit that like button. It helps more than you think. And if you're into honest, no fluff financial content, subscribe to Control Cash so you don't miss what's coming next. Also, I'd love to hear from you. What's one investing mistake you've made, or almost made? Drop it in the comments. Thanks for watching, stay consistent, stay calm, and remember, wealth isn't built overnight, but it is built by showing up again and again. Keep stacking those dividends, and I'll see you in the next one.